It's gonna be interesting to see how regulations pay out for crypto, right? Because or any other types of digital assets, because the boomers have stocks to sell. Does anyone want these stocks? Maybe to some extent. Do they want that big suburban house or whatever they have or apartment in the city? I don't know. So I think there's going to be a massive issue in terms of if the younger generation wants to buy things that the older generation is selling, and they need to sell those things to fund their retirement. How does that square? Are they going to increase taxes because the asset prices of things the boomers own and went down and they can't afford their retirement? So then they're going to tax the young more to pay for their retirement. And are the young going to accept that? I don't know.
What would you guess?
I think there's going to be a lot of intergenerational conflict. I don't know the outcome of it.
What?
But it could be money printing at the end of the day, right? Because it's a very easy way for the government to solve this problem. It's going to be interesting to see how regulations pay out for crypto, right? Because or any other types of digital assets, because the boomers have stocks to sell. Does anyone want these stocks? Maybe to some extent. Do they want that big suburban house or whatever they have or apartment in the city? I don't know. So I think there's going to be a massive issue in terms of if the younger generation wants to buy things that the older generation is selling, and they need to sell those things to fund their retirement. How does that square? Are they going to increase taxes because the asset prices of things the boomers own and went down and they can't afford their retirement? So then they're going to tax the young more to pay for their retirement. And are the young going to accept that? I don't know.
What would you guess?
I think there's going to be a lot of intergenerational conflict. I don't know the outcome of it.
What?
But it could be money printing at the end of the day, right? Because it's a very easy way for the government to solve this problem.
That's the solution of everything.
Does money printing lead to more degen activity usually?
Yes, because again, if you don't have a lot of financial assets and you're watching all this inflation happen all around you, you have to use more leverage in the little bit of savings you have to. I think that'll be rolled in slowly over time, and so you're not going to see this knee-jerk reaction. I think the Trump administration learned that these sorts of massive sort of changes are going to create outcomes that they don't like, which is heightened bond market volatility, things going the wrong way. And so if capital controls are going to be phased in over time, they know that they need to replace that buying. Either it's the Fed, it's the Treasury, it's the banking system, it's some other private sector actor that is allowed to create credit very cheaply and therefore replace these foreigners who will be forced to sell these assets.
Stocks have re-correlated with the 10-year yield, and so has Bitcoin. Do you see that correlation holding between these three classes?
No, I think that there will be some risk off events, and we'll see bond market volatility heightened. I think Bitcoin will sort of assert itself as a hedge against this. Foreign money went into the U.S. because the U.S. markets have been the best performing, whether it's stocks, bonds, or real estate. And if that money is leaving and it's going to go back into their local markets, then the U.S. markets don't do so well. And maybe it's better to own Taiwanese stocks or Indonesian stocks or Thai stocks, or all these other emerging market countries who are basically going to say, okay, we're forced to repatriate this money back on shore. Our currencies appreciate. Our consumer gets wealthier because now they can purchase more things, and maybe people want to build business domestically to service that economy. I think it's a way to allow banks to engage in the same sort of trade that Tether does. And so if I'm a bank and now I can create my own stablecoin, I essentially can onboard deposits at zero cost. And then if they remove the supplemental leverage ratio exemption, I can buy a T-bill and I get to capture 100% of that income. So I think that we get to 250,000 by the end of the year. It'll be bumpy along the way, obviously, but that's sort of my end of year price target. And then $1 million Bitcoin is what I just got off stage talking about how they're going to print, I think, in the realm of $9 trillion-ish between now and that period of time. And that is, Fannie and Freddie, the government support entities that are allowed to create mortgages in the US. They will print $5 trillion. You will have probably up to $1 trillion purchased by the banking system due to supplemental leverage ratio exemptions and purchasing things that the foreigners are selling. And I think the banks are going to because they now don't have to hold all this equity capital against their treasury book. They can lend more into the real American economy. And so you're going to see the amount of loans going to manufacturing firms increase, which is, again, that's an increase in credit, and that will make its way into crypto as well. So Bitcoin has a fixed supply. It's obviously a much smaller market in terms of market cap. And so if you have a lot of things chasing a very small door, then the price goes up on the margin. And so that's why Bitcoin has been the best performing financial asset in the last 15 years. It depends on, what the financial pressures are of the government, right? So I think they have a 200,000 Bitcoin that they seize from people, the US government that is, and that could be sold. Obviously, if there's a budget pressure, then that's there's variable. There's money there to sell it, so they can sell it.
Yeah, but do you see them buying more Bitcoin? They haven't done that yet.
I don't think it's politically palatable to buy Bitcoin and print money. I think if you're going to print money, okay, either it's tax cuts or it's build a bridge or build a hospital, or these sorts of things that benefit more people than just a small sector of people who own Bitcoin. I mean, they could. Anything is possible, but I just think it's bad politics. I think if you create all this money and you could spend it on anything you want, surely spending it on buying Bitcoin is probably not going to be the best way to get votes. Well, I think obviously it's probably less decentralized than they advertised. And it seems like, the people in charge of Hyperliquid decided that they wanted to preserve the buying power of their HLP versus adhering to what the market was saying with the liquidations of this jelly token. So on one hand, yes, it's not very decentralized. On the other hand, it's like, oh, well, I guess they really care about this HLP, which is the backstop for a lot of the markets. So I feel more comfortable trading there. Because at the end of the day, traders don't care about decentralization. They just want liquidity, and they want a nice range of products to trade. So if Hyperliquid offers that in a decentralized way, then fine, let's trade there. I don't think they care, right? A lot of people are just invested in the index. And so they own an ETF, and the ETF owns a lot of stuff, right? That may or may not agree with their particular sensibilities, but they don't care. They just want to be in the index.
With exchanges and centralized exchanges becoming more mainstream, do you see a scenario in which they start siphoning deposits from the regular person from large financial institutions like JP Morgan's and the Bank of Americas of the world?
I don't think so, because these banks have better distribution networks than the crypto companies.
So there's no direct competition in the foreseeable future.
Oh, there absolutely is direct competition, right? So if JP Morgan offers the ability to buy Bitcoin and Coinbase does, it's the same Bitcoin that you're buying, right? So then it comes down to really just fees. And so can JP Morgan offer a 0 fee trading because they make so much other money in other places around the bank versus Coinbase offering 0% trading? I don't know. I'm not an expert on the Coinbase revenue drivers, but I would imagine a lot of their revenue comes from this very high margin brokerage business that they operate. And so if a JP Morgan or Bank of America says it's 0 fee Bitcoin trading, bring your balances here, bring your bank deposits here, well, then what is Coinbase going to do? Yeah, so it's quite interesting. I don't know, won't go too deep into it, but essentially there were some interesting articles written in the FT by, I think, Brad Setzer and another economist, basically documenting how Taiwan life insurers are probably some of the richest institutions in the world who've been investing abroad. And essentially, Taiwan is obviously a big global manufacturing hub, semiconductors and all that. But the government and the central bank has a policy of keeping the Taiwan dollar very, very weak. And so to do that, they have to create Taiwan dollar local liquidity, which obviously is the reason why apartments are so expensive in Taipei and other cities. And they accumulate dollars. But they don't want to look bad like currency manipulators to the United States government. So they take all these dollars and they funnel them to the Taiwanese life insurers. And then these life insurers go and they buy bonds and enter in all sorts of structured derivatives with large banks. Essentially, they have a lot of U.S. Treasury bond exposure. And also, a lot of hedge funds like to fund themselves in Taiwan dollar because of this persistent weakness that is encouraged by the government. And then they engage in massive carry trades. And so what happened in the first week of May is that there was this fear that, oh my God, what if the Taiwanese lifers start going out of the treasury market, taking that money and repatriating into the Taiwan dollar? And basically, a lot of these hedge funds exited their carry trades and got stopped out. And that's why you saw the 6 or 7% move in the Taiwan dollar. And I think that the authorities didn't want to step in and create more money in Taiwan to basically reverse those flows, because they wanted to show to the Trump team when they're negotiating that, hey, we're not about to let our currency continue to weaken. We accept that we're going to have to allow the Taiwan dollar to strengthen. And I think that's why you had this sort of massive move in the Taiwan dollar. And I expect it to continue to strengthen over time.
Do you think that's going to happen in other Asian countries?
Yes, and it already started. You saw it in South Korea. You see it to some extent in Singapore, Malaysia, and Thailand. Any of these countries that run these persistent programs of currency weakness, accumulation of dollars in their reserve account, and investing abroad, that money's coming back.
And you said there is capital control in U.S. coming.
Yes.
On foreign investment ownership.
So I think they're going to start by taking away the withholding tax exemption. There's already talk of that happening where, foreigners don't pay the 30% tax that Americans do, getting interest on their bonds. So they're going to remove that. And so it's going to mean that, hey, maybe this treasury bond isn't so attractive, and I'll I'm not going to own that. I'll own something else.
Mm.
So I think that's going to start happening.
Does that mean a market crash?
No, because they'll print the money to make sure that all the foreigners who leave, they'll replace that with printed money.
The retail interest in the altcoins, and actually some people track also crypto channel volume, viewership volume, is significantly lower now than 4 years ago, despite the fact that Bitcoin and many other things have reached new highs.
Again, I think a lot of these coins have not performed very well. They were priced wrong. They were priced too expensive. And then their actual fundamentals, when you actually said, okay, you're launched, the hype is over. Okay, where are the clients? Where's the revenue? Oh, we don't have any.
Yeah.
But this thing is a 5 billion FDV. Well, you can't 10x that. It's just hard. So you go from 5 to 50. It's easy to 10x 100 to 1 billion in terms of on the marginal price basis. So I think it's just the price is too expensive.
Is it too far-fetched to say that Bitcoin has become an institutional instrument now and the retail crowd is just no longer interested in that?
No, I'm sure there's lots of retail interest in Bitcoin. It's been well performing and it's the easiest one to understand.
Okay. Open interest in Bitcoin futures reached unprecedented levels recently. I think it was, checking my notes, $80 billion on May 22nd, $15 billion increase in just 5 days. It's highlighting just unprecedented leverage. What does this signal to you?
Just more interest in the space, right? Obviously, we rallied up towards all-time high, and obviously people are opening more leverage positions, thinking that we're going to run, past 110, much higher quickly. I think we want to look for basis expanding. So what's that premium of Bitcoin versus other things? And so I don't think it's anything crazy yet. It's like 10% or something.
How often do you rotate in and out of Bitcoin?
Not that often. Maybe I might make one or two big buying or selling things every year. Because again, I don't want to be trading too much.
Yeah. You don't have like a rebalance mandate?
No. There's no mandates. The mandate is outperform Bitcoin. So if we can invest in a new project and it outperforms the Bitcoin capital that we had to sell to invest, that's good. And then we'll buy more Bitcoin with our profits.
Right. Well, we've talked to a lot of Bitcoin maxis that say that the only way to outperform Bitcoin is to buy more Bitcoin. So in a sense,
Well, I mean, I think that's false because you could obviously there's a time period. Over what time period, right? Solana was at 7 and it went up to 300. If you put all your money in Solana at $7 and sold it all at 300, you definitely outperform Bitcoin over that time period. So,
how do you personally pick altcoin? What do you look at?
Narrative. And now it's all about cash flow. So, do you generate a lot of cash flows? Is there a way for me as the investor to get paid by supporting you by owning your coin?
And not the valuation.
Well, I mean, early stage stuff, we have caps on how much we'll pay, very specific. But liquid stuff, it's really about cash flows for me.
Don't you feel narrative change too quickly? It's very hard to catch on.
It does, but if you pay the right price, it doesn't matter. If you pay a low enough price, if it launches, most likely you'll make money. But if you pay the high price when you're chasing the narrative and trying to be in every single big deal, then that's when you lose money.
Welcome back, everyone, to the Deep Dive. Today, we're plunging into a really fascinating set of observations from Arthur Hayes, one of the most provocative thinkers out there in finance. Our mission, like always, is to unpack the most important nuggets, the key insights from his recent comments. We're talking big picture stuff here, macroeconomics, huge shifts in intergenerational wealth, global capital flows, and the future of digital assets, especially Bitcoin. There's definitely a lot to untangle, but we're here to try and make sense of it all for you. Cut through the noise.
Absolutely. And these are just, abstract theories. Hayes is giving us really timely, really relevant insights. They help understand the deep currents shaping markets right now and maybe what the financial landscape looks like tomorrow. We'll try to connect these dots, these different observations, show you how they kind of form a coherent picture of what's going on globally and crucially, why you should probably be paying attention.
Okay, so let's kick things off with the central challenge Hayes identifies. It really sets the stage for everything else. It's this stark reality. The boomers have stocks to sell. And this isn't just like a simple demographic thing. It's creating a pretty significant intergenerational conflict. You have this older generation needing to sell assets, stocks, big suburban houses, city apartments to fund their retirement. And the big question is, well, will younger generations who have their own economic pressures be willing or even able to buy these assets at the prices boomers expect? It feels like a fundamental imbalance.
It really is. And Hayes sees basically two main ways governments might react to this huge looming transfer. One option, theoretically, is hiking taxes significantly on the younger generation, fund boomer retirement that way. But that brings up massive questions, right? Political feasibility, social acceptance. Will the young actually stand for that? Especially if asset prices dip, making retirement harder to fund anyway. Hayes seems pretty skeptical that's politically viable, with the younger, larger voting bloc.
So what's the alternative then?
Well, the far more probable path, and what Hayes seems to think is almost baked in, is money printing. He calls it a very easy way for the government to solve this problem. Almost like it's the solution to everything because, well, it avoids direct taxes and the immediate political heat.
Right. And it's not just about solving the funding gap. Hayes points out this fascinating side effect of constant money printing. He calls it DGEN activity. And it's not just crypto slang. It's about how people react when inflation eats away at their savings. Especially those with fewer assets. They see their purchasing power just eroding day by day. So they feel this immense pressure to chase returns. Right? Often pushing them into really extreme risks, high leverage, volatile stuff, just trying to keep up.
Yeah, trying to outrun inflation.
Exactly. And that shapes market behavior in profound ways. Lots of boom and bust in speculative assets.
And what's really insightful is Hayes' prediction on how this happens. Any capital replacement by the government, Fed, Treasury, banks, whatever, he expects it to be rolled in slowly over time. It won't be a sudden jolt. He thinks they learn lessons from past administrations, maybe the Trump era, about how sudden liquidity moves can cause problems.
Like bond market volatility or worse.
Exactly. So the approach will likely be gradual, designed so if foreign money leaves, domestic players step in smoothly, replace that demand without, triggering a market shock, aiming for a soft landing or maybe a controlled slide. Now, let's pivot a bit to global capital flows. This is another really critical piece of Hayes' thinking. He's got this compelling view that foreign money, which, poured into the U.S. for years because markets here were doing so well, stocks, bonds, real estate.
Like the safe haven, best game in town idea.
Yeah, that's now starting to leave. It's being repatriated, going back to local emerging markets. He mentions places like Taiwan, Indonesia, Thailand, South Korea, Singapore, Malaysia. We're seeing hints of this trend already. The drivers are mixed, maybe better growth prospects back home, securing local supply chains, maybe just U.S. assets looking expensive after a long run.
And the mechanism Hayes describes for what happens when that money goes home is really interesting. When capital is repatriated, it naturally makes those emerging market currencies appreciate. Right? More demand for the local currency, it gets stronger. And that, in turn, makes their consumers relatively wealthier. Their money buys more internationally. It can also boost domestic business, maybe making imports cheaper for local industries.
It's like a feedback loop, potentially reigniting those local economies.
Which leads to the big question. How does the U.S. react if foreign capital keeps flowing out?
Right. Hayes thinks the U.S. might actually make its own treasuries less attractive to foreigners. One key way he points to is potentially removing the withholding tax exemption that foreigners currently get on U.S. bond interest.
Ah, okay. So foreigners don't pay U.S. tax on that interest now.
Correct. Removing that exemption would cut their net yield, making U.S. bonds less appealing for them. But here's the crucial part Hayes emphasizes. Money printing will happen to make sure that all the foreigners who leave, they'll replace that with printed money. Essentially, ensuring there's a domestic buyer of last resort to government, or banks helped by policy stepping in to prevent a bond market crash, maintaining stability, on the surface at least.
Okay, so where does Bitcoin fit into all this complex global dance of money and policy?
Hayes sees Bitcoin really asserting itself as a hedge against this whole risk-off environment, the outflow from U.S. markets.
Even though we've seen it correlate more with stocks and yields recently?
Yeah, he acknowledges that correlation. Things have moved together sometimes, challenging the uncorrelated asset narrative a bit. But he seems firm in his belief that Bitcoin will diverge, especially during real risk-off events or when bond market volatility spikes. Particularly if the government is printing money to prop up bonds, it becomes that sort of escape hatch, right? A non-sovereign digital alternative when faith in traditional stuff wobbles.
And his specific predictions are, well, ambitious. He's talked about a $250,000 Bitcoin by year-end, maybe eventually $1 million per coin. He links this directly to an estimated $9 trillion in upcoming money printing he sees coming from the U.S. government.
Yeah, and breaking that down, he sees about $5 trillion potentially coming via Fannie Mae and Freddie Mac, the government-backed mortgage giants. It's not literal printing, but them buying up huge amounts of mortgage-backed securities injects massive liquidity. He sees it as kind of stealth money creation.
Okay.
Then maybe up to $1 trillion bought by banks, partly because of those SLR exemptions, the supplemental leverage ratio rules.
Right, meaning banks don't need as much capital against their treasuries.
Exactly. Frees up their balance sheets to buy more government debt, replacing foreign sellers, or maybe lend more into the real economy, like to manufacturing firms, for instance. It's just this enormous potential flow of liquidity into the system.
And why does Bitcoin benefit so much, disproportionately even, from all this credit and money printing?
Well, it comes down to that fixed supply, right? And its relatively small market cap compared to, say, the bond market or stock market. You have all this new liquidity chasing a very limited fixed number of assets. On the margin, it just drives the price up significantly. That's basically why it's been the best performing asset over the last 15 years or so. It's a direct beneficiary when fiat currency gets debased.
What about the government's own Bitcoin holdings? They have around 200,000 from seizures, right?
Yeah, they do. It's an asset on their books. And they could sell it if they needed cash, if budget pressures got intense. But Hayes doesn't really see them actively buying more Bitcoin. He thinks that's politically difficult. His argument is if the government is going to print money, it's probably better spent on things like bridges or hospitals, things that benefit everyone, rather than buying a specific digital asset.
Okay, so broadening out from Bitcoin to the wider crypto market, there's this interesting observation. Retail interest in altcoins seems way down compared to 4 years ago, even with Bitcoin hitting new highs. Why is that?
Hayes thinks many altcoins were just priced wrong, way too expensive for what they actually offered, lacking fundamentals. He asks that blunt question, where are the clients? Where's the revenue?
Right. No real business model for many.
Exactly. Once the speculative hype died down, there wasn't much substance left for a lot of them. But retail interest in Bitcoin stays strong because, well, it's performed well. And honestly, it's the easiest one for most people to grasp. The store value idea, the hedge concept, the complexity and poor performance of many alts just scared retail investors away.
But that contrasts sharply with what's happening in the institutional or derivatives markets, doesn't it?
Massively, yeah. The open interest in Bitcoin futures hit totally unprecedented levels recently, like $80 billion around May 22nd. That was a huge jump, like $15 billion in just 5 days. That doesn't just mean more interest. Hayes points out it signals unprecedented leverage.
So big bets being placed.
Huge bets. Institutional players, sophisticated traders, taking on highly leveraged positions, expecting big price moves. It shows more serious interest for sure, but it also means the market might be more fragile, more vulnerable to big liquidations if the price swings the wrong way. It's kind of a double-edged sword, high conviction, but also high risk.
And what about Hayes' own approach to trading this stuff? Bitcoin versus altcoins.
He says he doesn't actually rotate in and out of Bitcoin that often, maybe just 1 or 2 significant moves a year. No strict rebalancing rules. His main goal is simply to outperform Bitcoin, again, by investing in what he sees as promising new projects, altcoins, and then taking the profits from those to buy more Bitcoin.
And his criteria for picking those alts have changed.
Yeah, quite significantly. He says it used to be mostly about the narrative, the story the project told, but now it's all about cash flow. He wants to know if he, as an investor, can actually get paid by holding the coin through staking, protocol fees, some direct economic benefit. And critically, he stresses paying the right price, getting in low enough to mitigate the risk because, as we know, narratives can change super fast, leaving you holding worthless bags.
Okay, one last point. The competition between crypto exchanges like Coinbase and the big banks like JP Morgan, does he see them going head-to-head soon?
Not really, no, not in the foreseeable future. His argument, which is pretty compelling, is that banks just have far superior distribution. They already have millions of customers, established trust, easy access to money, things crypto firms are still building.
Makes sense. The infrastructure is already there for banks.
Right. But he does concede that competition could emerge on fees. Imagine if a giant bank offered zero-fee Bitcoin trading, leveraging their huge client base. That would seriously challenge platforms like Coinbase that rely heavily on those trading fees. So it's less about crypto product innovation, more about distribution muscle and cost structure.
So there you have it. A deep dive into Arthur Hayes's really profound and, let's be honest, often audacious insights. We've covered these huge intergenerational economic shifts he anticipates, the fascinating global capital flows shifting from west to east, and Bitcoin's growing role both as a hedge and maybe a major beneficiary of macro policy, especially the sheer scale of money printing he expects.
Indeed. It's a really complex picture Hayes paint, isn't it? One where a lot of traditional financial assumptions are definitely being put to the test. So thinking about all these shifting dynamics and the wealth transfer, the capital flows, this unprecedented level of potential money printing, it makes you wonder what new financial paradigms might be emerging from all this. And maybe more importantly for you listening, how might you position yourself to navigate it all as the world's economic plates keep shifting under our feet?